two things on it. One, should someone that's really laser focused, should they even look up and evaluate the boat? And two, what about these times? You spoke about Buffett. You had this great talk a few weeks ago about inflation.
Mm-hmm. Of course, bonds can swindle the equity investor too. Everything, inflation, I should say, swindles the bond investor too, and it swindles the person who keeps their cash under their mattress. It swindles almost everybody, and the problem, if you have a business that doesn't take any capital, and let's just say the dollar depreciates 90% or something, so things cost 10 times as much. If it doesn't take any capital, you can charge 10 times as much, and you've kept your relative position. But most businesses take some capital. If our utility business, just say that the dollar is worth 1/10, some years hence from now, we have to have 10 times the capital investment, basically. And we get paid a return on that. But we have forced capital investment to essentially keep them in the same place. And
about maybe what your boat should or shouldn't look like in high inflationary times, which we're clearly in now. So does inflation impact any of what you've described in terms of evaluating the boat or what you do with it?
I would say two components. So first would be someone's timeline. And so if they're like 5 years from retirement, it doesn't really make sense. You should eke out the compounding returns you have of the 30 years that you put into whatever it is. Or not should. That would be, if I were in that instance, that's what I would do. If you can think in longer cycles and you have 1-2 entrepreneurial cycles left, then you get the opportunity cost starts to really weigh in. Where you're like, okay, well, I might not make as much next year, but 3 years from now, I could be making 5 times as much. Am I willing to give up 2 years of earning to make 5 times more 3 years from now and then set myself up for the rest of that time? The younger you are, in my opinion, the more you should be taking those types of bets. And then within an inflationary period, this is, Uncle Warren speaking, but you want to have things that have low capital expenses, so you don't need to add new equipment, new facilities in order to expand whatever business you're in. And then you want it to be things that produce lots of cash flow. And so if you have something that's high cash flow and has low capital expenses, when you're growing in an inflationary period, you can adjust the prices very easily. And when you make those adjustments, it drops straight to bottom line rather than having to then go back, buy more equipment, which now has eaten up that additional cash flow.
Yeah. See, I totally agree with you, by the way. This idea right now of, scalability, which we're going to talk about in a minute too. By the way, when he says young people, when you're listening to this man speak, he's 32 years old.